Welcome to the Fiduciary Wise podcast. I'm Kate McBride, one of your hosts from Fiduciary Wise. Whether you're a thought leader, service provider, CEO, or decision maker, this podcast is for you. We break down the best practices, services, and solutions available to you and discuss the latest topics and shake up industry norms. Join us as we explore, challenge, and navigate the future of fiduciary responsibility together. I'm Kate McBride, AIFA, CFEX analyst, and a board-certified fiduciary. I'm an ERISA 402A specialist at Fiduciary Wise and a member of the Department of Labor's ERISA Advisory Council.
Hey, Kate. I'm glad to be here with you today. I'm Marta Hurst. I'm a partner at Fiduciary Wise. I spent 17 years on the TPA side of the business, doing business development, really, but learning a lot about compliance and administration. And that is what we are hoping to cover today. So I appreciate the opportunity to kind of share with you what I've learned over the last few years.
So what are the basics of plan design and compliance for plan sponsors?
Sure. So basics of plan design and compliance. This is the plan document, which includes any required restatements or amendments. So that governs the plan. It lays out what the plan features are, what types of contributions you want, what your eligibility looks like, what different types of distributions you might allow if you allow loans. All of those things are documented within the plan document, and that is what governs the plan. That's what dictates how the plan operates. So that falls under a plan design component of that. Also would be, are you safe harbor? Are you doing profit sharing contributions? So we can talk a little bit more about that in a little bit, but that plan document, the written plan document that is executed, it is the kind of starting point to plan design and compliance. And then the annual compliance is the testing calculations. If you are making a profit sharing contribution and you want to look at options for that, that would be fall under that compliance piece. How do you make sure that you get the contributions that you want to the people that you want to, and what are the rules that regulate that? Like you can't give just the owners the maximum contribution and not give one to anybody else. So compliance is following all the rules associated with that. And then once all that is done, there is a 5500 preparation that's the government form that gets filed that says, here's how much is in my plan, how many people. If you're a big plan, then it's a much longer form with a lot more information, but it is that annual required reporting to the DOL of what's going on. It's the tax return essentially for the retirement plan.
So that one goes to the IRS?
You file it through the DOL website. I guess technically all the government agencies have access to the things that they want.
All right. Well, good. Well, so who provides the services that you were just talking about?
So very often it's what we call a third-party administrator, or TPA. So there may be a standalone TPA associated with the plan. We talked last episode about record keepers. So the record keeper is that website that you go to where you see that record keeper's name is the name on the statements, kind of the more recognizable name. The TPA may not be. It might be somebody that only the people in HR are working with to do that annual compliance piece. It could also be the record keeper. So sometimes those are called bundled services where the record keeper is also providing those administrative services. Actually, I was talking with somebody today about a payroll company that has a retirement plan. And so in that case, some subsidiary maybe within the payroll company or the payroll company is also providing that as well. So those are third-party administration functions, but they could be performed by a TPA, by the record keeper. So those are kind of the most two common that we see in this space.
Are those the services that they perform, are they fiduciary services or non-fiduciary? Or is it a mix?
So yeah, excellent question. So the compliance components are non-fiduciary functions. So they are again, using those document provisions. We are utilizing this type of contributions. We are utilizing this eligibility and entry. So it is just a product of what is written in the document. So there's no fiduciary decisions being made there. It is just completing the administration as is outlined in the plan document. So those are non-fiduciary services. There are some fiduciary services, though, available kind of on the administration side. So often you might see that as like signing the 5500. That is a fiduciary function, and there are some service providers that will do that as part of their agreement. So occasionally you do see some, perhaps limited 316 services, like notice. Delivering notices is not a fiduciary function, but somebody kind of handling that process of who is delivering and did all the right notices go out, and did they go to the right people? There are some fiduciary services like that that might be offered through different service providers.
Hi, I'm Kate McBride with Fiduciary Wise. We know that managing retirement plans comes with a lot of responsibility, and having the right knowledge is crucial to making the best decisions for your plan and participants. That's why at Fiduciary Wise, we don't just provide fiduciary services, we're committed to educating those who manage retirement plans through resources like the Fiduciary Wise Brief. Our program delivers expert insights to help you navigate the complexities of ERISA, compliance, and the fiduciary risk management. If you're finding value in what you're hearing in this podcast and want to take your understanding to the next level, let's continue the conversation. Reach out to us at fiduciarywise.com/scheduling and learn how we can support you with the knowledge and tools you need to confidently manage your plans. So I have heard that signing the 5500 form, the IRS 5500 form, is a fiduciary act, and that not everyone understands that if they're the plan sponsor signing that form because someone has brought that form to them and told them, well, this is your 5500, go ahead and sign it and then file it. What are the consequences of that when a plan sponsor signs that form? What does that actually mean?
So they are responsible for the information that is in it. So they are verifying. I think of it similar to when you file your personal taxes. Even if you have a CPA, ultimately you are signing off and you are saying, I agree with the information that is being submitted. So like when I get my taxes back from my CPA, I go through and say, okay, these things make sense to me. This kind of stands out, ask some questions. That's the same kind of thing should be happening with the 5500. I know I've worked with plan sponsors for a long time. There are definitely plan sponsors that as soon as it hits their inbox, they go click all the buttons to get it signed. And we love responsive people, but it does make me wonder if anybody actually put their eyes on that 5500 and the work that went with it. But then there are plan sponsors out there that I know even in my TPA days, they would call and say, okay, I got my 5500. Let's go through every line and make sure I understand what I'm signing. So anybody who is signing a 5500 needs to understand what the information is that is being put in there. Because not only are you signing it saying, this is as right as I know it to be, but that then your name is also out there because I mentioned that the 5500 is submitted through the DOL website. Right. That information it is public information, so people can see your signature on there, which means you might also be getting those solicitation calls about, oh, hey, I see that you signed the 5500 for a retirement plan. So not only is it a fiduciary duty and a fiduciary liability, if you aren't sure what you're doing, that liability gets greater. But then you are also putting your name out there for people to kind of poke you about the 401k plan. And that's how places get their lists of people who they should call to solicit 401k business. So those names are out there, public information, not difficult to find. But a lot of people want to be able to have somebody else put their name on it. So certainly some TPAs offer those types of services. Here at Fiduciary Wise, of course, as the 402A fiduciary, we sign the 5500. So we've got somebody at Fiduciary Wise, our name is on that, rather than somebody at the employer getting those solicitation calls.
So that's one of the services that Fiduciary Wise provides. And why is that important, especially in case of a lawsuit against a plan?
Sure. So if Well, I'd say a lawsuit, DOL or IRS looking at those 5500s. The person who signed is the person who is going to get the request for information, for a meeting, for get their names on the hook. So I will say, on our 5500s we do sign, but a lot of times the employer, at least the entity name is on the 5500. So sometimes those notices go to the employer rather than we're typically listed as a plan administrator. Those requests should all come back to Fiduciary Wise. So we can help handle and address any IRS, DOL inquiries or any lawsuits for retirement plans. Those should all start with our office.
So it might seem like we're spending a lot of time on the Form 5500, but because it's such an important legal document, it's worth, just a little bit more discussion of. So Fiduciary Wise, as the 402A, the ERISA 402A named fiduciary for a plan, really takes that role off of the plan sponsor's shoulders. So signing that 5500, which would normally be signed by the plan sponsor with all the legal and administrative functions that go with that, becomes a fiduciary wise function and comes off of those plan sponsor shoulders. Some people don't realize how important that is, but other plan sponsors actually know really how important that is. We've had people comment when we are, doing sort of the intake meetings and say, oh, didn't know you signed the 5500 as, fiduciary wise did that. Why is that such a key document and such a very important way of taking fiduciary liability from a plan sponsor onto Fiduciary Wise's shoulders?
Well, I think for the reasons you just said, people don't realize the amount of liability that they are when they're putting their name on it. If there are mistakes or errors or issues with regard to the plan, that's the name that's on everything. So it's not just this should have been 20 cents instead of 5 cents. It's also the person that is signing off on the plan in general. So, there are certain aspects that we've talked about in some future episodes, things that need to be happening within the plan. If there's a complaint from a participant, if there is, IRS starts coming to poke around, that's the name that's going. That's the first name that they see. That's the obvious spot to start to ask questions about what is going on within the plan. So anytime
So
somebody
that
else's
very,
name
very
can be on
public
there.
document.
Okay, yeah, that very public document where anybody can look up and see. And
Yeah.
there, one of my favorite things to do, because I'm nerdy, is to go poke around 5500s. And so I used to be even worse about it than I am now, especially when I was working for a TPA. So I would go to, some school party and I'd meet somebody who worked for some big company, and I would come back and I would look up their 5500. And if it is an audit size plan, there's a lot of extra schedules. There's an audit report you can review. And I used to love going through and see kind of like what's going on with this plan. And can I see from just this government form that, I don't know, with an audit, maybe it's 30 pages. Can I glean some information on what's going on with that plan? And you can. So, I mean, if I can do it, DOL can do it, IRS can do it, attorneys can do it. So, not everything is out there, but when you've been in this business long enough, you can kind of, connect some dots on these 5500s to see opportunity, to see things that maybe aren't going great. I know sometimes if we have people reach out to us through our website, they'll give us their company name. And that's one of the first things I do is go out there and see, okay, have they been timely filing their 5500? Are there issues that were reported in their audit? What does their eligibility look like if it's on the audit? Can I figure out who their service providers are based on different schedules that are in there? So we love doing stuff like that. And yeah, who signed it? And do we have any connection to them? So kind of back to that compliance side, there are 316 providers out there that will sign your 5500. I think a lot of people, when they think about 316, think about things like notice delivery and approving loans and distributions. And really, some of those are 316 functions. They're not. It's not necessarily a fiduciary role. It is, a ministerial role, making sure that that information is being sent out. Somebody has to send it out. Somebody has to make sure that somebody is sending it out. Somebody has to have the checks and balances in place to do that. There has to be a policy and procedure around that. So Kate and I love talking about policies and procedures. We did that earlier today.
Yeah.
But I do want to point out that 402 fiduciaries are different than 316 fiduciaries. So 316 fiduciary
Yes.
is an administrative fiduciary. So when we talk about, and we talked about in our first episode, the three different kind of pillars or buckets of ERISA, we've got legal and management, we've got investments, and then the administration. So that 316 fiduciary is only relevant in that administration space. So yes, they might sign the 5,500, they might approve loans and distributions, but the 402 fiduciary is the one who is really the overarching fiduciary for all of it. Somebody referred to us as a fiduciary blanket the other day, and that's my favorite thing ever. We just lay over the top of the whole thing. It's
I do
all
like
covered up.
that.
You just stick you can't get rid of all of it, right? So you just stick the top of your head out from under this blanket. But otherwise, the 402 covers it all.
Hey, I'm Isaac Wood with Fiduciary Wise. With years of experience helping plan sponsors, TPAs, record keepers, and advisors navigate the complexities of retirement plans, I understand that every client has unique needs. That's why our MEP, PEP, and DC group of plan services offer complete customization. Whether you're managing multiple plans or looking to streamline administration, we tailor solutions that fit your goals while also ensuring compliance with ERISA regulations. At Fiduciary Wise, we don't just offer cookie cutter options. We work closely with you to design a plan that maximizes efficiency, minimizes risk, and gives you the control that you need. Imagine the confidence of knowing that you have an experienced team behind you, guiding you every step of the way. If you're ready to take your retirement plan to the next level, let's connect. You can schedule a meeting at fiduciarywise.com/scheduling to see how we can help.
Thanks, Marta. So let's talk about best practices and what should be considered for best practices for compliance.
Okay, so best practices on the compliance side. Plan design consultation, I think, is a super big deal. I've seen a lot of plans over the years that get, I have an example because I like horror stories. Well, this one isn't necessarily a horror story, just an example of not a best practice. So several years ago, we ran across a retirement plan. They were doing a very generous employer match of 100% of the first 4%, and it was 100% vested from day one. Very nice, right? It was not a safe harbor plan. So their highly compensated employees were receiving refunds because they had to comply with ADP testing because it wasn't safe harbor. Well, they were meeting the requirements of having a safe harbor match and getting forgiveness from that ADP test. But that was not a best practice for that administration firm to say, oh, you're doing all the things of safe harbor, but it's not technically safe harbor. So, all they had to do is send an annual notice and they would have been meeting all the requirements of that. So, consulting on that piece, like a safe harbor contribution. So we talk about safe harbor in a few different manners at Fiduciary Wise. We get safe harbors for investment types. We get a 404C safe harbor. So a safe harbor in plan design is when the plan sponsor is willing to do some things like give a stated matching contribution, for example, make it 100% vested. There's a few different versions of safe harbor. But then as a result, they get forgiveness from that ADP testing, potentially top heavy, depending on what other contributions they might be making. So having a consultation about what works for your business, what works for the plan sponsor's business, really is a best practice. So, and when we talk about eligibility too, we've got plans with various eligibilities. Sometimes it's immediate because that's what they need for the culture of their business. Sometimes that doesn't make sense given their turnover. So having conversations about what makes the most sense for my plan, my group, my employees, How do I make this a meaningful benefit? But how do I make it so, I don't drive my HR people crazy, because we've got people floating in and out of this thing every week. Automatic enrollment. There are new requirements about automatic enrollment. So plans that are starting now, or even in the last year, a little over a year, they have to include automatic enrollment when they roll their plans out. So understanding, knowing what the rules are, partnering with people who know what the rules are to make sure that you are complying on that side. What types of employer contributions are going to be made? So we talked about profit sharing. Are there safe harbor contributions? Are there potentially other plans that are working in conjunction with the 401k plan, like maybe a cash balance plan? So maybe there's some kind of combo plan. Again, all about what makes sense for the employer, what are the goals that they have for their retirement plan, and being able to have a plan design consultation to talk about that. And then I think a couple of things, staying up to date on upcoming regulations. So, Secure 2.0 came out. We've got a lot of deadlines coming up for, different components of that, like catch-up contributions have to be Roth. So when you're talking about best practices, what are your service providers doing, your TPA or your record keeper that is doing your compliance? How are they helping you make sure that you are staying up to date on those upcoming regulations and deadlines? What new provisions are required and or available? So I think I think all the service providers are doing a little bit of dabbling in that, but really, ultimately, it comes down to the administration and compliance. How is that being tracked? What reporting is required as a part of it? What updates in the plan document have to happen? So they are really a key component in making sure that operates smoothly. And then automatic force outs. This is one of my pet peeves, is people who don't have good automatic force out provisions in place. And same,
what is the force out provision? Can you explain it?
Thank you. Yes. So a force out provision has to do with your terminated employees. So when a participant leaves employment, they are eligible for a distribution from the plan. If they have a vested balance under now $7,000, they can be forced out into an IRA in their name. So what often happens, especially if you're working with providers who get paid based on participants with a balance, they don't have any desire to force those people out. They don't want to, because they get paid if those people have a balance in the plan. But if you work with good providers, when we were talking about best practices, this is best practice. Put a procedure in place for force outs and then make sure that it happens. I've seen plans. I ran across a plan several years ago. They had like 700 people with a balance. They only had like 250 employees.
And, oh my goodness.
Oh my gosh. It was awful. There are some providers that are definitely known for kind of have a reputation for letting those participants with a balance grow, because it works in their billing benefit. But that is one, it's in the document. I mean, if it's in the document, you should do it. And so it was in there, but nobody was making sure that those things were happening. And it resulted in a ton of additional expense for that employer. I've also run across plans over the years that are, just over audit size. And if they would pay out some of their terminated people, they might be able to go under that audit threshold, which saves $10,000, $15,000, $20,000 on an audit. So that's the best practice, making sure that you've got force out provisions in the plan and that somebody is executing those. We talked about horror stories, Kate and I, when we were preparing for this podcast. I was going to ask
if you had some more.
So I do have one more in particular that I would like to bring up. Several years ago, my prior firm took over a plan that was top heavy. So if you are top heavy, it means that the key employees within your plan have more than 60% of the plan assets. So key employees,
so like
it's a little bit different definition
kind of thing, you mean?
Yes.
Like it's like, okay.
Yes. And it really means that the definition of a key employee is a little bit different than a highly compensated employee, but a lot of times they they definitely have some overlap. So basically we're trying to make sure that all of the top people in the organ, not us, but from a government standpoint, from the ERISA standpoint, we're trying to make sure that the owners and their spouses and families aren't getting all of the benefit while your rank and file employees get nothing, or not enough. So we took over a plan. It was top heavy. When you take over a plan, you request records from the prior providers so you can kind of build your file and know what's going on within the plan. So I had the pleasure of calling this client to say, hey, I noticed that your plan is top heavy. Have you made your top heavy minimum contribution for this year? And he said, I don't know what you're talking about. And I was like, well, I see it's in the letter that you got. It looks like you were top heavy the year before too. And we're just trying to make sure these contributions got made. And he said, I've never made an employer contribution. I'm not doing that. I didn't sign up for that. And this is my favorite. He said, I wasn't top heavy. I didn't have this problem until I hired you. And I said, oh, sir, you did have that problem. You just ignored it. And so when we talk about best practice, also that firm, that they should have been saying, hey, you have to make your time. Yes, it was in a letter, but the client never read the letter. We know clients that don't read the letters. I get it. You're doing other stuff. But somebody has to be responsible for that, which makes a great time to hire a fiduciary wise if you don't want to read those letters that come from your TPA. But that TPA also should have said, you have to make this requirement. You have to make this contribution. They had been top heavy for many years. They were not happy with me, but it wasn't my fault. They just didn't. They weren't working with a firm that had, when we were talking about best practices, reading things that come from your TPA, that's the best practice. But then also working with providers that make sure that you are, okay, compliant. Mr. Business Owner, I see you haven't made your top heavy minimum contribution yet. I need you to make that, or here's your options. There was no consulting that was going on. So I'd say, if anything, when we talk about best practices, it's about making sure that you are working with somebody who's consulting with you and talking about what things are coming up, what would work best for your company, and how to do that in the most efficient manner. We would love here at Fiduciary Wise to have conversations with you about if you have questions about who you are working with and if it is operating well. So certainly we would love the opportunity to talk to you about this. And if you're interested in not looking at everything that comes from the TPA and you need somebody to kind of help you navigate that, we are certainly happy to do that as well.
Thank you, Marta Hurst, partner at Fiduciary Wise. And thank you for tuning in to the Fiduciary Wise podcast. We'd love to hear your thoughts and answer your questions, so drop us a comment, send us a message, or schedule a meeting with us at fiduciarywise.com/scheduling. Hi, I'm Kate McBride with Fiduciary Wise. Did you know that if you sponsor a retirement plan, if you sign the plan's Form 5500, more than 92% of the fiduciary risks and liability can fall directly on your shoulders? ERISA's complex regulations make it easy to miss key responsibilities and leave you exposed to costly penalties or legal action. At Fiduciary Wise, we help you manage that risk. We become the plan's named fiduciary, taking on the majority of those responsibilities. We work with your current service providers, including the investment manager, advisor, record keeper, and administrator, to ensure regulatory compliance. And we handle the heavy lifting so you don't have to. Our team is dedicated to protecting you and running your plan exclusively in the best interest of your employees, reducing your exposure to liability and giving you peace of mind. When you partner with Fiduciary Wise, you can focus on running your business, knowing that your retirement plan is in safe hands. Let's talk about how we can help shield you from fiduciary risk. Schedule a meeting today at fiduciarywise.com/scheduling.